Want to build wealth with one of the safest investments? Real estate is your golden ticket. Let's dive into why it outshines all the other options. Real estate investments are one of the most powerful and profitable investment strategies available today. In fact, Gallup surveys finds that people have considered real estate the best long-term investment for 12 years in a row. And here's the best part. You don't need to be a seasoned pro to get started. You don't even need prior real estate experience because there's so much more to it than just owning and flipping houses. You could be as active or passive of an investor as you'd like, while still enjoying a steady passive income stream, tax incentives, leverage, and long-term growth. Welcome to the channel. My name is Blake Alewelt, owner of the Bravo Ridge Group at eXp Realty. Are you ready to take the first step learning how to generate extra income, build wealth, and gain your financial freedom? Let's dive into why we should be looking to investing in real estate to begin with. The benefits of real estate investing. The benefits of real estate investing are clear and significant. From tax benefits to steady passive income, here are the main advantages you'll enjoy as a real estate investor. Number 1, cash flow. For real estate investors, cash flow is the income left over after paying expenses such as your mortgage, taxes, insurance, vacancies, repairs and maintenance, utilities, and any other expenses that affect that property. If you have renters, your goal is for the rent you pull in each month to exceed your expenses, resulting in a positive cash flow. Your cash flow will typically increase as you purchase more properties and increase rents to keep up with current market conditions. Number 2, mortgage principal paydown. When you get a loan for a property, you make a mortgage payment every month. Principal paydown is simply the part of the mortgage each month that is applied to the loan balance instead of the interest that you pay to the bank. On an interest-only loan, the principal paydown amount is 0. On an amortized loan, a loan where you make scheduled payments on the principal and interest over time, the higher the amortization, the less principal is paid down each month. Number 3, appreciation. Appreciation is the increase of a real estate property's value over time, and alongside long-term buy and hold passive income is how investors make most of our money. Despite inevitable fluctuations, real estate values have consistently increased, and that's unlikely to change. Number 4, leverage. Real estate leverage is when you tap into borrowed money, such as conventional loans, personal loans, or other assets to expand your potential return on investment. With leverage, you can buy a more costly house or more homes than you can afford to just pay for outright. Now that we have a basic understanding of some of these terms, let's see how they all work together in the following real-life example. So you just purchased a single-family home priced right at $300,000 with the intent of renting it out this property as a long-term buy and hold investment. Utilizing leverage, let's say you, the investor, made a 20% down payment of $60,000 and obtained a mortgage of $240,000 to purchase this $300,000 home. In this case, the investor is using a leverage of 4-to-1, meaning that you're using $240,000 of borrowed money to control a property worth $300,000. With the appreciation, if the value of the home increases by 5% per year, the value of the home would be $315,000. In this case, the investor's equity in the property would increase by $15,000, which would be the appreciation of the home. Then you have the mortgage principal paydown. So assume the mortgage has a 30-year term and the interest rate is 7%. If the investor makes payments on the loan from rent received by the tenant, over time, the balance of the loan will decrease, and the investor will continue to build equity in the property. For example, after 5 years, the outstanding balance of the loan would be roughly $226,000, and the investor's equity in the property would be approximately $74,000, assuming no appreciation in the property value occurred. Then there's my favorite, the cash flow. Assume the investor rents out the property of $2,000 per month, and the monthly expenses, including mortgage, property taxes, insurance, and any repairs and maintenance, is $1,700. In this scenario, the investor, you, would generate $300 in passive cash flow each month. This positive cash flow can be used to pay off the mortgage balance more quickly or as a steady stream of income. Number 5, depreciation. There are many tax benefits in real estate investing, and depreciation is key among them. And you did hear me right. Not only do real estate investors benefit from appreciation, we also benefit from depreciation. The IRS views properties as assets, just like cars, but better. Depreciation covers an asset's wear and tear over time. So when a property is purchased, the cost of the property can be depreciated over a period of 27.5 years. for residential properties and 39 years for commercial properties. This means that each year, a certain percentage of the cost of the property can be written off as a business expense. To calculate the depreciation, divide your property's value by 27.5 years for residential properties and 39 if it's commercial. If your duplex is worth $800,000, your depreciation expense is $29,091. Let's say your duplex generates $80,000 in income for the year, and you pay 25% of that to federal income tax. Then taxes owed without the depreciation is $80,000 times 0.25, $20,000. With depreciation, $80,000 minus the $29,000 times that 0.25 is $12,700. In this scenario, you would save just shy of $7,300 in taxes, all thanks to depreciation. That's more than $600 per month. Number 6, hedge against inflation. We investors hedge against inflation in several ways. Property values generally rise at a rate higher than inflation, though this can be heavily dependent on individual markets, and rent generally increases to keep up with inflation. Also, fixed-rate loans mean your monthly mortgage payments remain the same, despite inflation. For example, if you have a 30-year fixed-rate loan for $1,000 a month, you'll pay $1,000 a month for 30 years, even though that $1,000 30 years from now doesn't nearly go as far. Now, let's cover how real estate investing compares to other types of investing. Stocks, certificates of deposits or CDs, bonds, and gold can all help you accumulate wealth. However, real estate has unique offerings that other investments lack. You often control your net income. With other investments, your money's in the hands of company officers. While this is true with some forms of real estate investing like crowdfunding or real estate investment trusts or REITs, many forms put you in control of your own investments, which I'm a fan of. So here's how investing in real estate measures up to other investment opportunities. Stocks and mutual funds. Like real estate, stocks and mutual funds tend to increase over time, and investors can enjoy a good return on investment. For example, the median return for the S&P 500 is 8.6%. You can also diversify your portfolio by investing in multiple companies simultaneously. However, the stock market is unpredictable. Market volatility causes dramatic shifts in stocks, and many investors watch their money accumulate only for our growth to be completely leveled by circumstances we can't control. CDs and bonds. Certificates of deposit or CDs are low-risk, low-reward investment opportunities. Their profit potential is directly linked to interest rates. So while you may enjoy a guaranteed return on investment, it's not always as profitable as real estate. CDs also lack many tax benefits that we real estate investors enjoy, like depreciation and leverage. Current average annual percentage yields, or APYs, for CDs range somewhere between 3.25 and 5.5, according to Bankrate.com. Bonds share many of the same qualities as CDs, as well as their setbacks. They are low risk, and their tax benefits are minimal compared to what you'll experience when investing in real estate. Then there's gold. Historically, gold also consistently appreciates in value. However, you have no control on how quickly it accumulates in wealth, and it accumulates at a much slower rate than real estate properties. So what is the ROI for real estate investing? Your return on investment can vary substantially based on your experience, location, investment type, and numerous other factors. However, real estate investors usually build more wealth than we would in other types of investments. So here are the average annual ROIs for the most common types of real estate investing. There's residential real estate at 10.6%, commercial real estate at 9.5%, and real estate investment trusts, or REITs, at 11.8%. These numbers show that all three of these real estate investing avenues usually provide greater returns than the S&P 500. So it's worth noting that the above ROIs generally don't account for aggregate cash flow over time, nor the advantages of using leverage to maximize your cash-on-cash return. So most real estate investors will tell you that these ROIs will be substantially higher. Okay, now who can invest in real estate? Not long ago, investing in real estate was only an option for people who could afford to put 20% down on a property. Luckily, a lot has changed in the last couple years. Almost anyone can invest in real estate, and sometimes with little to none of your own money. However, we strongly recommend getting a healthy real estate education before getting started. If you've decided real estate investing is right for you, you'll definitely want to check out BiggerPockets. They have hundreds of videos and thousands of articles about all aspects of real estate investing. And that wraps up this introductory video about real estate investing. I hope this gave you everything you need to know to decide whether real estate investing is right for you. Please hit the like and subscribe buttons down below, as in the next video we dive deeper into the finances involved when you invest in real estate. If you're looking to invest here in the Des Moines, Iowa market, I am an agent here and would love to help you grow your portfolio. Please feel free to reach out to me anytime. I look forward to hearing from you.